July has some people jumping for joy, but most have jitters. Hey folks, it's Eric Powers back with you from Sky Blue Wealth, back to recap the month of July 2022. Don't forget to hit that like button and subscribe to our podcast and blog for more information about retirement planning and other fun financial topics. I truly hope this summer has been good to you. I mean it. Anything beats 2020, right? Well, guess what? It's been so good to so many people who've been traveling, they've been spending money, they've been going out to restaurants, spending on services, as they return back to living life and getting back to the real world. July has certainly been a month for travel and leisure. My family and I, we also got to recharge our batteries this month by going to Bermuda for a week, where the water was clear, the fish are colorful, and the sky was blue. You see what I did there with sky blue? Anyways. July was also a month that we had many people joyful about what the markets had returned to them. If you weren't paying attention to the market in July, it was the best 1 month gain we've seen in almost 2 years. In fact, the Standard & Poor, the S&P, was up 8%, the Dow was up 6%, and the Nasdaq was up double digits to 11%, which is a much better feeling than that heavy red line of all of the down months prior this year. The July market was also positive in some respects because it was actually expecting bad news from corporate America. It was expecting earnings and profits to be hurt. However, many key companies that are closely watched beat analyst expectations, so values were lifted. And also, the market that was widely expecting a 0.75% interest rate hike from the Fed didn't get surprised. That's what it was. I wish I could say this is all roses and the economy is strong and markets will continue to move up and to the right. But as a responsible financial guy, I want you to know the full picture about what we're watching and what we're thinking. Remember how we said that markets were up in July and that corporate earnings were a contributor? Well, that's really part of the story since corporations get their earnings and profits from our personal spending, which we've been doing a lot of, right? Through COVID, we've been buying stuff. But now we're spending money on services like vacations and dinners and services that make us feel good. But as you've noticed, things have gotten really expensive, and the Fed needs to control inflation in order to keep things and services at a reasonable cost in the future. So as much as we, the consumer, love the feeling of spending money on things that we want and need, we've been doing too much of it in order for it to be sustainable. And that's what economists call the demand side of the supply and demand curve. The other biggie that's driving higher prices is the supply side, which, as you've heard here before, is complicated by China lockdowns and Russia's war in Ukraine. I recently saw a meme that made me laugh because it's so true right now. It went like this: I really wish I weren't living through a major historical event right now. Think about it. We've got a once-in-a-century pandemic. We've got a once-in-a-generation record high inflation. 2 increasingly assertive geopolitical opponents. And a financial asset bubble, perhaps, deflating both stocks and bonds at the same time. And although the meme is funny, it's the pain that we're all going through that we want to end. And it will, but it will take some time. As we've been putting this video together, the economists say we're not in a recession because consumer spending is still high and unemployment is low. The Fed is doing what it can to encourage us to slow our spending, which we're not doing quickly enough. So they have to bring the stick of raising interest rates that much more. Unfortunately, the fact is that they don't have a lot of other tools available to drive down inflation, so they have to lean hard into the one that they do have. And while they have to raise rates, they're hoping to do it without putting too much stress on business. As it stands now, there's only a whiff of hiring slowdowns. What we're watching for closely at this point is further hiring slowdowns or hiring freezes or large-scale layoffs, which would point more towards a recession. So to bring this month's recap together and to bring out the financial advisor in me, if we continue to spend but at lower levels and live within our means to avoid unproductive debt, we have a shot at getting through this recession, or maybe avoiding one, without too much pain in our lifestyle. This bear market is unlike any other, in large part because of the unusual foreign factors. Many market analysts don't think we've locked in bottom yet, or if we have, we should anticipate low single-digit returns. And some are waiting for capitulation, another way of saying fire sale sell-offs across all asset sectors and classes and all pessimistic. So I guess a good question is this: is it time for buying or a time to realign your portfolio to what you believe? I have my opinions and encourage you to connect with me by email or schedule a meeting or a call. And don't forget to give me a like and let me know if you have any questions.